Hello, everyone, and welcome back to a new accounting episode. For today's agenda, we're going to go for a quick recap on part one, dividends, part one. And from there, we're going to go for dividends, part two. So, a quick reminder last time we talked about dividends, non cumulative dividends. Today, we're going to talk about cumulative dividends, and we're going to have a quick recap at the end. So let's start here with a quick recap. So we talked about dividends, and dividends, as we said before, uh, those are a retained earnings that the business decide to give away. So it's not an obligation. So therefore, they are not a liability. They are not liability. Those are equity. So they are not liability. They are not obligated. Business board is not obligated to give them away. Important dates, we had announcement date, ex-dividend date, record date, and payment date. We had an example, non-cumulative, of a non-cumulative dividends, and we have seen how these were distributed between preferred and common stockholder. Today, we're gonna continue how we're gonna, first of all, I'm gonna show you how you record this in your booking. And we're going to go for a cumulative dividends and how those are distributed between common and preferred shareholders. So let's go for a quick entry here. We have two entries. We have a declaration date, or the date that the business board announced to give away some of the return or earnings. So as we said before, this is not an obligation. A business board is not obligated to do this. So therefore, they are not a liability. Those are debits. So a debit, uh, they are not liability, so they're equity, as we said. So here, how you're gonna do it? You're gonna debit the return earnings, 8,000. I'll show you the example here. So here's the example on December 31st, 2019. The business decide 8,000. Those are similar. 30,000 in 2020, 20,000 in 2021, and 50,000 in 2022. However, we're gonna go for the 8,000. Those are the same thing. You just need to change the amount or the dollar number. So when the business decide to give away this money or distribute this money, you're gonna debit the return earnings, the amount they decide to give away, 8,000, debit, and they are not liability, therefore they're equity. Now we're gonna credit dividends payable. Dividends payable, same amount, and those are credit. So debit, return earnings, credit, dividends payable. This is on your announcement date, or the day you decide or declare giving away them. Now, on the day you're gonna really pay them, so in the payment day or the day that you're gonna pay out this money, so you're gonna debit dividends payable and credit cash. Debit dividends payable and credit cash. And that's how it's been recorded. So very simple here. This amount can be changed depend on how much the business board decide to give away. Now we're gonna continue talking about the cumulative bonds or stocks. So now let's take an example. Same example or similar one that we had before. This is how you're gonna calculate the annual preferred dividend. So why we care about the preferred one? Because they got the privilege. The preferred uh, stockholders get the privilege, or they have the advantage getting their money first before the common stockholder. So they take the money first, even if a business has gone out of business or bankrupted or whatever happens or liquidation, they take their money first. So before any creditors, they take their money because they have the privilege. then the money goes for the rest of creditors. However, let's go back to the calculation. So let's do the same numbers here. 8,000 will be given away. So those 8,000 are between preferred and common stockholders. So 8,000, 30,000, 20, and 50. So let's see how this is going to work. The interest rate here for cumulative is 4%. So let's say here. Now, we're going to have to work on the annual preferred dividends first. Why? Because preferred stockholder will get the money first before the common. If there's not enough money for both of them, unfortunately, common stockholders are out of luck. They have nothing to be paid. These people will get paid first. So this is same case as cumulative. Cumulative and non-cumulative are the same way to calculate it. However, we're going to see the difference between them when the money is given away to the preferred stockholders. And this is the only difference that we're going to see. Let's go for the numbers. I'm going to make it easy for you. So now let's take the annual. So how much those are eligible for? The cumulative preferred stockholders are eligible for 9,600. How did we get this number? Let's see here. We had preferred stockholders, 6,000 shares. Each of them is $40 par value or face value. But the common stock, they are much more, as you see, 1,110,000 shares at the rate of $3 par value or face value. So this is how we're going to work it out. So you're going to take this number, 6,000 times 40, 240,000 times 4% comes up with 9,600. And 9,600 must be given to the preferred stockholder first. Then the rest goes to common. In our example, unfortunately, the business board decided for 8,000 only. 8,000 only. So common is out of luck. Nothing will be paid for them. Why? Because these people need 9,600 first before common stockholder. So 8,000, 0 common, and this is total 8,000. Now the main difference between cumulative and non-cumulative. Cumulative, they will take out or carry out, you're going to carry out 1,600, where I came up with this number. 8,000 are giving away. They are eligible for 9,600. So 1,600 will be carried out for the next payment. The next one we have here would be 30,000. So the board decided in this year, 2022, to give away 30,000. So here we're going to have 8,000. I'm sorry, we're going to have 9,600 plus 1,600 from the year before. 9,600 the annual plus 1,600. The rest goes to common. The rest of 30,000. So let's see how this is going to work. 9,600 is what they're eligible for. 1,600 carried out from the last year. A total of 11,200. The rest of the 30,000 here, that's what the business decided to do. The rest of this money goes for common, 18,800. Okay, so cumulative must get 9,600 every year. What happens if the money is not enough? Then they're going to carry out for the next year. Okay, so let's take the next one. The next year, we have 20,000. So let's do it here. So you can think about it for now. 20,000 here. Nothing owed. Nothing has been owed from them. So these people they owe none for this year. So they're going to get the 96 annual only because they got paid for the difference for the year 2019. They got it on 2020. The balance here, the balance is 0, so they're going to take 9,600 only. So how much will be left? 20,000. It's going to be 20,000 total, 9,600 here, and the rest goes for common. Now let's see year 2022, what's going to happen. Year 2022, we got 50,000 to be given away. Okay, let's do it then. So 50,000 in total. Balance from last year, 0. So here we're going to have 9,600. The rest of 50,000 will be given to common. 40,400. 9,600, 40,400. Now, how are we going to do this in booking? How are we going to enter this transaction? I've done it before. Exactly. It doesn't matter whether it's cumulative or non-cumulative. It doesn't matter at all. All care about making this equity as a liability. We're going to make it as a liability, so it's an obligation. This is decided by the board, so it's not equal for every year. So they're not going to be 8,000 every year, 20, 30, 50. It depends. Depend what the board is going to decide for, how much they're going to give away. So 8,000, we're going to debit retained earnings, and we're going to credit dividends payable. And when it's paid out, we're going to debit the dividends payable and credit cash. Okay, so that was all for part 2 today. Next time, we're going to go for part 3. I'm going to explain to you how is stock bonds are sold in the market and why sometimes the price is different. Sometimes it's lower, sometimes it's higher than par value. Okay, I would like to thank you again for joining me, and I will see you next time. We're going to talk about selling and buying bonds in the secondary market. Thank you again, everyone, and I will see you shortly. Have a nice day.